What if I told you that a paper route running teenager could one day become the richest person on Earth just by following a handful of timeless investing rules? Today, we're taking an even deeper dive into Warren Buffett's legendary strategy. From the nitty-gritty of intrinsic value calculations to the subtle art of judging management quality. Whether you're a novice investor or a seasoned pro, you'll walk away with actionable insights you can apply to your own portfolio. Let's jump right in. 1. The foundation, value investing. Buffett's bedrock principle is value investing, inherited from his mentor Benjamin Graham. But what exactly does value mean? Intrinsic value defined: the discounted sum of all future cash flows a business will generate. Margin of safety, buying at a price well below intrinsic value to cushion against estimation errors or market volatility. Real-world example: in the 1960s, Buffett paid $7.60 a share for Geico. When it traded at a steep discount to book value, he understood that the company's future earnings power far exceeded its depressed stock price. 2. Circle of competence expanded. Buffett teaches that true confidence comes from knowing your limits. But how do you define your own circle? 1. Inventory your expertise. List industries you've worked in, studied, or followed closely, whether retail, consumer staples, or healthcare. 2. Test yourself. Can you explain the business model in one clear sentence? If not, it's outside your circle. 3. Expand deliberately. Read industry reports, attend conferences, and talk with professionals to gradually widen your circle. Never dive in blind. 3. Hunting for economic moats. A great company is more than just profitable today. It has defenses that protect its profits for years to come. Types of moats: brand power, Coca-Cola's global recognition and loyal customer base. Cost advantages: Walmart's scale lets it underprice competitors. Network effects: Visa's value grows as more merchants and cardholders join. Intangible assets: patents, regulatory licenses, or exclusive partnerships. Moat check: ask what would happen if a new competitor entered tomorrow. If the answer isn't immediately threatening, you've likely found a moat. 4. Intrinsic value deep dive. Let's break down the discounted cash flow DCF model, step by step. 1. Project revenues and margins. Use historical financials to estimate revenue growth and net margins for the next 5 to 10 years. 2. Forecast free cash flow FCF. Subtract capital expenditures and working capital needs from operating cash flow. 3. Select a discount rate. Reflects your required return. Buffett often uses 9 to 10%, roughly the long-term equity market return. 4. Compute present value. Discount each year's FCF, sum them, and add a terminal value, often via perpetual growth formula. 5. Sensitivity analysis. Test different growth and discount rate scenarios to understand how your value estimate changes. 5. Management matters. Even the best business can falter under poor leadership. Here's how Buffett sizes up CEOs and boards. Integrity first. Has management consistently honored its word on guidance, disclosures, and corporate governance? Capital allocation track record. Do they reinvest profits at high returns or chase low acquisitions? Shareholder-friendly practices. Examples include share buybacks at a discount, sensible dividend policies, or spin-offs that unlock value. Red flags: excessive executive compensation and linked to performance, opaque accounting, or frequent earnings surprises. 6. Patience and the magic of compounding. Buffett calls compounding the eighth wonder of the world, but compounding doesn't happen overnight. It's a multi-decade affair. Case study: at $10,000, investment in Berkshire Hathaway in 1965 would be worth over $46 million today. Psychology of patience. Why short-term market noise, quarterly earnings misses, or macroeconomic headlines shouldn't derail your commitment to high-quality businesses. 7. Emotional discipline and Mr. Market. Buffett's favorite metaphor is Benjamin Graham's. Mr. Market, a business partner whose mood swings create bargain opportunities. Fear versus greed cycles. During the 2008 crisis, Buffett invested billions in Goldman Sachs and General Electric at attractive yields. Actionable tip: before reacting to any market drop, ask, is the underlying business impaired? Or is this just Mr. Market sulking? 8. Concentration with conviction. Contrary to popular advice, Buffett believes in concentrated bets when you've done the work. Berkshire's top holdings, as of 2025, just 10 names account for over 60% of the public equity portfolio. When to diversify: if you lack the time or expertise for deep research, low-cost broad market ETFs, like the S&P 500, remain a prudent choice. 9. Advanced case studies. 1. Geico 1951. Buffett first bought shares at $35 today's equivalent holding would be worth tens of millions. 2. Wells Fargo 1989. A $640 million investment turned into a $26 billion profit before Buffett gradually trimmed for valuation reasons. 3. Apple Inc. 2016 present overcame Buffett's tech hesitance. Now a key dividend and buyback engine for Berkshire. 10. Taxes, cash reserves, and insurance float. To lesser-known pillars of Buffett's strategy. Insurance float. Premiums received before claims are paid accrue as low cost capital. Berkshire's float exceeds $150 billion. Tax efficiency. Holding winners forever defers capital gains taxes. Plus, Berkshire pays little in dividends, compounding retained earnings. 11. How to implement Buffett's playbook. 1. Study the classics. Read The Intelligent Investor and Buffett's annual letters at berkshirehathaway.com. 2. Build your watch list. Screen for companies with ROIC greater than 10%, net debt to EBITDA 2x, and durable moats. 3. Perform DCF models. Even a simple 3-year projection will sharpen your valuation skills. 4. Monitor quarterly reports. Focus on cash flow health, margin trends, and any debt red flags. 5. Stay invested. Embrace volatility. Treat market dips as opportunities to buy more of your best ideas. 12. Common pitfalls and how to avoid them. Overpaying for growth. High revenue growth can mask unprofitable business models. Chasing hot tips. Buffett warns against investing in things you hear on the street. Ignoring the balance sheet. Strong income statement is meaningless without a solid capital structure. Warren Buffett's success isn't magic, it's the disciplined application of a few simple, time-tested principles, focusing on intrinsic value, staying within your circle of competence, and letting compounding work its wonders. By studying his playbook, doing your homework, and maintaining emotional discipline, you too can build a portfolio designed for multi-generational wealth. Thank you for joining us on this deep dive. If you found value in today's episode, smash that like button, subscribe to FinWorld for more expert-level investing insights, and hit the bell icon so you never miss a beat. And you're watching FinWorld, where smart money meets smart thinking. See you next time.